Welcome back. We are now in segment 8.2, and in this segment we'll be discussing about a very important concept in working capital assessment, that is the net working capital, commonly known as NWC, right? So in the previous segment we discussed about the concept of working capital, why companies require working capital, right? It's basically to finance the working capital is basically to finance current assets, right? To finance the current assets, company require working capital. So what we discussed in the previous chapter is something called gross working capital. Okay, so we are now making a distinction between gross working capital and a net working capital. So the focus of this chapter will be NWC. This is the most important concept. We'll also discuss what is gross working capital. So gross working capital is the total investment in current assets that's required by the company. So we have discussed the various current assets, right? So we have discussed like, for example, inventory. Inventory is a current asset. Right? Debtors is a current asset. Right? So there are various current assets. So if you add up all those, right, what you arrive is known as gross working capital. So gross working capital can be thought of as the total investment in current assets. The total investment in current assets is nothing but the gross working capital. Okay. So say for example the inventory put together is 100 lakhs. Right. This includes the raw material, stocks and spares. Right. Work in progress and finished goods all put together 100 lakhs, and say for example we have data of 50 lakhs, so put together 150 lakhs is the gross working capital. Okay, you just add up the current assets. There are other current assets also, right? We have discussed the advances and cash and bank balance, but let us ignore for the moment. Basically the major current assets we are interested in are the inventory and the data. So if we add up those two, you get what is known as the gross working capital, right? But there is another term known as net working capital. Okay, so this is different from the gross working capital. So in our chapter on item was a discussion of balance sheet, we discussed an item called creditors, right? If you remember, under liabilities we discussed an item called creditors. What we said was that the raw material suppliers give time to the company, right? Say for example the company has purchased a raw material worth 10 lakhs from a particular supplier A. Now A gives some credit to the company. So we are the company, right? We are the company, and we are purchasing 10 lakhs material from A. Now we need not pay the amount directly, pay the 10 lakhs immediately right now, because A gives some credit. Just as we give credit to our customers, right? Our raw material suppliers also give us credit. The entire business usually runs on credit. Okay, both on the customer side and the supplier side. Okay, so we have some time, right? So what we can say is, one, see, when we are saying that current assets is being financed by a number of sources, one of the sources we can say is the creditors, right? In the sense that though the creditor is not giving us actual cash, by giving us time, what he's saying is by giving us time, he's allowing us to invest the 10 lakhs in some other purpose, right? Had he not given credit, we would have parted with 10 lakhs. But by giving us time, he's allowing us to use the 10 lakhs for some other purpose, and in that sense it is a sort of finance. Okay, so please keep that point in mind. So though a company needs to invest in gross working capital, it need not actually spend the entire amount of say for example this we arrived at 150 lakhs. The company need not entirely spend on 150 lakhs on the gross working capital, because there's something called creditors, right? So if the inventory we arrived at 100, the debtors was 150, put together we had 150, and we also have some creditors of 25. So yes, the company needs to invest 150 in current assets, but because it has also obtained 25 from the creditors, in effect it needs to invest only 25, 125, right? So this concept will become clear as we go forward. At the outset I just want to keep that point in mind. It will be clear once as we go along. Okay, so the creditors are giving us some cushion. Okay, so it is not just the creditors, all the other liabilities, the current liabilities as a whole, are giving us a cushion, in the sense that we need not pay them right now immediately. So current assets minus current liabilities is known as net working capital. So we'll see the interpretation of NWC. This is just a formula. In your interview, if you ask what is NWC, please don't give this formula like NWC is current assets minus current liabilities. Don't say that. Right? That's a very immature way of answering, and that is not the concept. We'll understand the concept of NWC, but at the beginning of the chapter I want you to understand that NWC working capital, the gross working capital, is just the total of current assets. It is the total investment in the current assets, and from that we deduct certain current liabilities item. Why we do that, right? We'll be seeing as we go along, right? So if you want to remember the formula, just keep in mind NWC. NWC is nothing but current assets minus current liabilities. Though this is not the concept, though if somebody asks you, this is not what should be saying, but from a formula point of view, if you want to do some basic calculations, NWC is current assets minus current liabilities. Before we go along, I also want to point out that NWC is quite a tricky concept, right? It's not a easy concept. Even experienced bankers find it a bit difficult to grasp, because you will see this, and that's the reason why this is a question that is usually asked in many of the promotion interviews. Okay, it's actually one of the questions that is used to judge the quality of the credit officers. Okay, I'm not scaring you by saying it's a difficult concept, but at the end of the chapter, if you don't fully understand the concept of NWC, it is okay. Okay, you can revisit the video, watch it a few more times and try to understand. And even if you don't understand, it's okay, because you are in good company. There are many people who, even experienced bankers, who find it difficult to understand this concept. So as you do your proposals, in your job, as you go along doing a lot of proposals, one day the concept will become very clear, right? So maybe 2 years or 3 years into your job, as you keep doing proposals, you'll be suddenly understanding this NWC. So don't be scared if you don't understand the concept even after completion of this chapter. Just be aware that there is a concept called NWC. You'll be using it daily in your credit proposals. And just understand the concept. Just try to understand what is the concept. Okay. That's what we'll be attempting to do in this chapter, right? But please just don't think that NWC is the difference between current assets minus current liabilities. That's just the formula, but that is not the concept. Okay, the concept we will try to clarify in this chapter. So in our discussion on the chapter of term loan appraisal, we discussed about the need for borrower's margin. We always said that banks will not finance entire credit requirement. Say for example, there is a car of 5 lakhs to be purchased. Bank will not sanction the entire term loan of 5 lakhs. Right? This is something which the bank does not do. The bank asks you bring in some margin, maybe 50,000, right? And we will sanction a loan of 4.5 lakhs. Put together it will be 5 lakhs. So this 50,000 known as the margin. It is always the responsibility of credit officer to ensure that there is the borrower's margin, some stake. Right? This need not be 50%. Right? This might be as small as 10% or 5%, some percent. Right? This depends on the bank's policy, but ensure that there should be some stake, some borrower stake. This we discussed already in the chapter on term loan appraisal. So there, under the means of finance, we discussed under term loans that the term loan, the fixed assets can be financed by various sources such as the promoter's equity. This is the margin. Okay, term loans, unsecured loan, share application money. So various sources. This we discussed in the term loan appraisal. Now in working capital also, right? There are a number of sources which finance the working capital, right? But for our understanding, let us start by saying that to finance current assets, three major sources. There are three major sources that finance working capital. Working capital, either it has to be financed by the borrowers, their own money, that is the margin, or banks finance it, right? Or creditors. So please remember, this is the starting point, right? We will slightly complicate it in future, but for the beginning, let us assume that working capital is majorly financed by three parties. One is the borrower, right? This is the margin. Okay. Then banks finance some portion of working capital, either in the form of OCC or some other working capital limit. Okay. And creditors finance the a part of the working capital. So, say for example, the total working capital is requirement is 100. So the financing can be of any share. Okay. So borrower might have just pumped in 10%. Bank might sanction finance to 70% of the current assets, and 20% by the creditors, or it could be some 20% by the borrower, right? Or 50% or 30%. So the financing mix, right? The financing mix of the current assets will vary, right? So what is the implication of that variation, right? What is the difference if a company finances its current assets as follows, vis-a-vis a company which finances current assets by this? So we are going to look into those aspects in this chapter. So let us take the example of where the total working capital requirement is 100 lakhs. Okay, and let us assume that the financing pattern is the borrower, that is the margin, right, is 25%. That is 25 lakhs here, right? This is 25 lakhs. Maybe the bank has sanctioned say 60 lakhs, right? And creditors have financed the balance. This is 15, right? 15 lakhs. Okay, put together this is the 100. So this is the financing mix, right? The financing pattern of the current assets in this particular example. Okay, so the 100 lakhs of working capital was financed by three parties: the borrower, the bank, and the creditors in this ratio. So can you identify which of these are short term and which are long term? Right? Can you do that? So if you remember a discussion which we had in the chapter on itemized discussion on balance sheet. So we said that bank borrowing. Please remember, this is not bank borrowings can be both term loans and working capital. Term loan is anyway a long-term liability that we already discussed, right? What we are dealing with here when we're saying bank borrowing, it is basically short-term borrowing, right? Like CC, right? SOD, PC, right? Short-term borrowing. So this is a short-term borrowing. So since we're speaking of liabilities, a short-term borrowing is known as a current liability, right? So bank borrowing is a current liability. Creditors is also current liability. This is also something we discuss. So what is the basis for this classification? This we already discussed. A liability which falls due, any liability which falls due for payment within the next 12 months. This we already defined. So this will be a current liability. Creditors are current liability because when you purchase the raw material, say 10 lakhs, the creditor has given some time to pay, say 30 days or 45 days. This is less than 1 year. Usually it is less than 1 month or 2 months, 3 months, at the most 3 months. Okay. So he's giving some time. But within the 1 year, in this case within 30 days or within 45 days, you have to make the payment. So there is a liability on part of the company. The company has to make a payment of 10 lakhs to the supplier within the next 30 days, within the next 45 days. So this is a current liability. That is a very simple concept, right? Any liability, any payment which you have to make within the next 12 months is a current liability, right? Bank borrowing is also a current liability. This we already discussed. Though technically CC gets renewed every year and gets rolled over. Technically companies never pay CC, right? But even then we consider this to be current liability because this is a demand loan in the sense that the bank can at any time, at any point of time, recall the advance. Okay, recall the advance. So, and basically it's the CC limit is meant for financing short-term assets, current assets. So it is proper to classify it as a current liability. Okay, so these two are current liabilities. What about borrower's margin? If you remember, we already discussed. We discussed the concept called residual claim. The promoters have something called the residual claim. That is, please recall our earlier discussion. This we already discussed. A residual claim is in the sense that if a company were to wind up today, right? If the company were to wind up today, say for example, the total by selling all the assets, the company has realized 100 lakhs, right? And the company will be making payments. It will be settling the juice of it. This is the last day of the business. The company has sold all its assets and realized 100 lakhs, and the balance sheet is telling it is 100 lakhs. Okay. So who are all the parties the company has to make payments? The owner has initially made some investment of say 20 lakhs. There's some bank term loan of say 60 lakhs. All other put together and the 20 lakhs. So 20, 60, 20, 100 lakhs. So what the company will do is with this 100 lakhs, right? The company will repay bank 60 lakhs, 20 lakhs to the outside parties, and the remaining 20 lakhs the owner will be taking the remaining 20 lakhs, which was his original investment. However, if the company could only realize 90 lakhs, in the earlier example, the company could realize 100 lakhs and settle the juice of all other parties. But if the company were to receive only 90 lakhs, so what it will do? The bank loan of 60 lakhs has to be paid. The other outside parties 20 lakhs has to be paid, put together 80, and the remaining 10 lakhs only will be going to the borrower, to the promoter, even though he invested 20 lakhs. This is a concept which we discussed earlier. Okay, please refer back to this concept if you're not clear. Whatever is left after settling the juice of the outside parties will be the residual amount left to the promoter. Okay, so that's why we call the owner's claim to be a residual claim. So this is not a current liability. This is a long-term liability. Okay, this is not even a term liability because when we say term liability, we speak of sources like bank term loan, unsecured loans, those sort of things. Okay, owner's equity is not current liability, but at the same time it's not term liability. Okay, it's something called owner's equity. It's a separate concept. Okay, it is perpetual. There's no repayment in the sense. Term loan, say for example, term loan from banks is to be paid within 5 years. But owner's claim is something which you don't pay in the normal course of events. Okay, it's only when the company gets wind up. So it's something more than term liability. Okay, so this is a separate name for it. This is an owner's equity. Okay, this is not even a term liability. Anyway, this is not a current liability. So what the point I want to make is, if you were to calculate NWC through a formula, we said NWC was current assets minus current liability. So here the current assets total put together was 100 lakhs. The current liability is only these two portions, the bank portion and the creditors portion. Only those two are the current liability. So here it is 75 lakhs. So the balance, so 100 minus 75 is 25 lakhs. So NWC is 25 lakhs. So please understand the interpretation of this 25 lakhs. Okay, mathematically we arrived at 25 lakhs being the difference between current assets minus current liabilities. The total current assets was 100, right? The total working capital is investment in current assets. So this 100 lakhs was financed by these parties. So this is the current assets, and these current assets was financed by these parties, these three parties. Okay, 25, 60, 15. This is the ratio in which it was financed. So current assets minus current liabilities is the NWC. Current assets was 100 minus current liabilities. These two are current liability, 60 plus 7, 15, 75. So NW is 25. So that this 25 is equal to this 25. This is a simplistic scenario. I will complicate this in a moment shortly. But for a simple understanding, the total current assets was 100. Under the liabilities there were only three parties, out of which two are current liabilities. Okay, this 100 was financed by this 25, 60, 15. So current liabilities was 75. So if I were to ask who financed this 100, you said 25, 60, 15, right? Is it clear? See here, the total current assets of 100 was financed by three parties. Who are they? Bank, this is a CC, right? A 15 was financed by the creditors, okay, and 25 was borrowed by the borrower's equity, is the promoter's margin, okay, right? So the total current assets of 100 was financed by a current liability portion of 75. These two are current liabilities, this we discussed, CC and creditors, and some portion from the long-term sources of 25. This is the long-term, this is not current liabilities, okay, this is the long-term. So 75 has come from the current liabilities and the balance has come from long-term liabilities. So when we speak of a formula like NWC is equal to current assets minus current liabilities. So current assets is 100 minus current liabilities is 75. 25. So this 25 is nothing but this 25. There's nothing special about it. It's bound to tally. When we're saying that the total 100 lakhs was financed by three parties, 60, 15, 25. From this, if you remove these two, you will be left with only this. That is pretty simple arithmetic, okay? From 100, if you subtract 60 and 15, you will be left with 25. So out of the three parties, if you remove these two parties, you will be left with this party. So what NWC is saying is, you find out the total current assets. From that portion, you remove the current liabilities portion, these two. You will be left with some amount. In this example, 25. That is nothing but the long-term sources. That is nothing but the financing from the long-term sources. So to put it in very simple words, NWC is the portion of current assets, right, that was financed from long-term sources. It might take some time to understand this, to digest this concept, but just try to understand. In our example, 100 lakhs was financed by bank of 60, bank CC of 60, creditors of 15, right, and margin, the borrower's margin of 15. When we are saying NWC is current assets minus current liabilities, current assets is 100 minus current liabilities is this portion. So what we are left with, right, that 25, NWC 25 means this 25. So what is this 25? This is the portion that is not relating to the current liabilities, right? This is the portion that has financed the current assets, right? This is the 25 lakhs is a portion that has financed the current assets. All these three have financed the current assets. The bank has financed in some part 60%, creditors have financed 15%, the borrower's margin has financed 25%. All three have contributed. What NWC is? Long-term portion that has financed the current assets, right? That portion of the current assets which was financed from the long-term sources. Forget about the short-term sources. Okay, few ways in which you can explain NWC to a layman. One, it is a measure of promoter's margin in the system. In our earlier example, when we got 25 lakhs, it is nothing but the borrows margin. So borrows margin can be two ways. See, the margin can be either towards fixed assets or current assets. So this we discussed under term loan. Okay, there is some margin the promoters have to put into the term loan. Otherwise, we won't. Bank will not sanction term loan. Okay, so fixed assets was 100 crores. So obviously, if the margin is 25%, bank will sanction only 75 crores. The borrowers have to bring 25 crores. This is the margin towards the this is the margin towards the fixed assets. Okay, but the borrowers also have to have their margin in the current assets, right? This actually we will slightly modify. It is not just the promoter's margin. Okay, so in the earlier example we had only the promoter's margin as the long-term source, but there might be other long-term sources which are not just from the promoter. So this we will modify in future slightly by saying it is a not just the promoter's margin, is also the long-term sources put together. But for the moment, let us assume it's just the promoter's margin, right? So it is a measure of the promoter's margin in the system. Another interpretation of NWC is, which we already discussed in the previous slide. Okay, this is a portion of current assets that was financed from long-term sources. Okay, so the current assets could be financed by some various sources put together. So take out all the current portion. So who financed? So be concerned only with the long-term portion. So the portion of current assets that was financed from long-term sources is also NWC, right? You can also intuitively understand NWC as a comfort of meeting current liabilities. See, current assets minus current liabilities, what we are saying is, if the current assets was, when you're saying NWC is current assets minus current liabilities, current assets was 100 lakhs, right? These are the inventory and debtors. You can sell them, right? You will realize cash from them shortly, maybe within the next 1 or 2 months, by selling the inventory, that is inventory converted into finished goods. Okay, and by realizing the debtors, you realize some cash. But there are also some immediate payments to be made, maybe to the raw material suppliers, maybe to the power company, right? Immediate payments, say for example 80 lakhs, right? Because you have some payments to be made in the near term, maybe in the next 1 or 2 months, but also you will receive some money in the next 1 or 2 months, 100 lakhs. There's a degree of comfort, 20 lakhs. If this goes to 90, you're slightly in a difficult situation, because even though you will receive 100 lakhs shortly, right? Definitely within the next 2-3 months, there are also some payments to be made within the next 2-3 months, that is 90 lakhs. So in a way you're constrained compared to the scenario where you had only liabilities of 80 lakhs. Say this is 100 lakhs, 110 lakhs or 120 lakhs. That is, current assets is only 100, whereas current liabilities is 150. In the next 2-3 months, you're going to receive payments totaling 100 lakhs. You can realize cash 100 lakhs. But you have payments to be made of 150 lakhs. So how are you going to meet the balance 50 lakhs? So this is not a good situation to be in. NWC measures the comfort of meeting current liabilities. If your NWC is high, like say for example your current assets were 200 and liabilities is only 50, so current assets and current liabilities is 150. This is a huge comfort, because you have only payments to be made of 50 lakhs in the near future, whereas you're going to realize 200 lakhs. So this is a very comfortable situation to be in. So NWC can also be thought of as a comfort level of meeting current liabilities intuitively, right? This is the intuitive definition, but if you want a more thorough definition, this is the correct definition. It is a portion of the current assets that is being financed that was financed from long-term sources. As a company, you always want your current assets to be financed more from the long-term sources. Think about it. Think about it for a moment. Okay, let us look at this example. So we are considering 4 scenarios here. In all the 4 scenarios, the current assets, the investment in current assets is 100 lakhs, right? It is same. What is different is who is financing this 100 lakhs, right? So your current assets can either be financed by your long-term sources or short-term sources. There are only 2 ways, right? Please understand, there are only 2 ways, right? We have classified the entire balance sheet. On the asset side, we have classified as current assets and everything that is not current asset. Right? Though this can be non-current asset, intangible asset, fixed assets, everything that is not current, either current or long-term. Similarly, on the liability side, either current liabilities or long-term liabilities. This includes also equity. So this is the basic classification, either current or long-term. Okay. So only 2 ways in which current assets can be financed. The liabilities either should be either it should be financed by the long-term sources or the short-term sources. So in this example, we are considering 4 scenarios where the current assets investment is same 100 lakhs, but Who is financing? The mix, the ratio of the long-term to short-term sources is varying. In the first example, the current liabilities have financed 75%, right? And the long-term sources, which if you remember, we defined as NWC, right? NWC is the portion of current assets that is financed by the long-term portion, the long-term sources. Okay, this we defined in the previous slide. Okay, so this is nothing but NWC. Or if you want to have a very simple understanding, let us say long-term. This is long-term. This is short-term. Okay, so the current assets was financed by 75% from short-term sources and 25% from the long-term sources in the first scenario. What happened in the second scenario? The financing pattern changed to 90-10. So compared to scenario 1, in scenario 2, more current liabilities for financing the current assets. Let us not go into, let us for a moment leave the 3 and 4. This is slightly complicated, which we'll get back to it shortly. So if you look at these two scenarios, what is the difference between these two scenarios, right? So we as a company, which is the scenario which you're more comfortable with? You always want a scenario where your current assets are financed more by the long-term sources. This is a scenario which you prefer. Scenario 1 is preferable compared to scenario 2, right? Scenario 1 is preferable over scenario 2. I'll tell you why. Here in the first scenario, you have some 75 lakhs payments to be made shortly. Let us define shortly as 2 months. Okay. In the next 2 months, you have to make payments of 75 lakhs to some let us assume entirely to the raw material suppliers. You have purchased some raw material from your raw material supplier, and you have to a payment is pending 75 lakhs. This you have to make in the next 2 months. Okay. Let us also assume that in the next 2 months you will going to receive 100 lakhs. This is maybe let us say debtors. Okay, you already made the sale and you have given a credit period of 2 months, and you are going to realize this amount in 2 months. So in 2 months time you are going to receive 100 lakhs and you are going to have a payment of 75 lakhs. So there is a buffer of 25 lakhs. In common language, let us say this is a buffer of 25 lakhs, right? So what is this buffer means? It means that this 75 lakhs will never decrease. Please remember, this 75 lakhs will never decrease. This is a payment you have already incurred. You have purchased the raw material, you have used it in your production process, so this will never go down. This is a payment you have to meet at any cost. But this can go down, right? What if the entire debtors don't pay you? I mean, there's going to be some bad debts, right? Maybe you don't realize the entire 100 lakhs, maybe only 90 lakhs or 80 lakhs, you don't know, right? Or maybe this current assets also include some inventory, right? Not just debtors. Maybe this is 80 inventory, 80 debtors, some 20 inventory. Maybe this inventory has become obsolete. You know, you're not going to realize the amount. So there could be various reasons why you're not why you're not going to realize 100 lakhs, right? So there is a risk involved. But this is a payment you have to meet. 75 lakhs won't come down. This is a liability you have to meet. So 25 lakhs provides a buffer to the in a sense that this is the amount by which your current assets can decrease. Suppose your current assets were to fall by 25 lakhs. Still, this 100 lakhs, if it falls by 25 lakhs, still it will be 75 lakhs. And with the 75, you can meet the payment of 75 lakhs. So 25 lakhs is a buffer in the sense that even if your current assets value were to fall by 25 lakhs, this 100 will become 75 lakhs. Still, you will be in a position to meet the 75 lakhs current liability. Is the point clear? So there is a buffer. But what in the second case? See what happens in the second case. The buffer is only 10 lakhs. 100 minus 90, buffer is only 10 lakhs. If the current assets, as in the first example, were to fall by 25 lakhs, if they become only 75 lakhs, say 25 lakhs debtors have not paid and it has become only 75 lakhs, you cannot meet the payment of 90 lakhs. Is it clear? If the shortfall was same in both cases, 25 lakhs, in the second case you will not be in a position to meet the payment of 90 lakhs, whereas in the first case you'll be able to meet the payment. So it is common sense. It is common sense to always have a large amount buffer. Current assets minus current liabilities. This gap, or this is nothing but NWC. This you want to be high. This gap you want to be high because of two reasons. One, it provides a buffer to meet the payments. Right? So if the value of the current assets were to fall due to some reason, still you will be able to meet the payment of the current liabilities portion. So this is a buffer. You want this gap to be high so that you are never going to default on this current liabilities. The second reason is, this we are speaking from the current assets portion, okay, from the side of the current assets. If this were to fall, we'll be still able to meet the payments. This is from the side of the angle of current assets. There is also an angle of liabilities. There is also a point of liabilities. If this gap is large, what it means is you have more time to repay, isn't it? In the first case, the 100 lakhs was financed by 25% from the long-term sources. This 25 lakhs you need not pay right now. This 75 lakhs you have to pay right now in the next 1 or 2 months. This is a short-term liability. But this long-term liability you need not pay right now. This is a long-term source. Long-term sources are sources which you need not pay immediately. This is from maybe from the borrows equity. Borrows equity you need not pay at all unless the company is wound up. So this is a very comfortable scenario. You want these sort of sources. You want sources where the company need not pay immediately. If you say, for example, if you're an individual, you have taken a car loan from your bank, from a bank. If you are given two choices, you pay this 5 lakhs in 1 year, bullet payment, pay the 5 lakhs in 1 year, or you pay it after 10 years. Which will you choose? If you were given more time to repay, you definitely want to avail this scenario. You obviously want to, you will want to avail this option. Why? This gives you more time to repay. Because you can use that 5 lakhs for other purposes in the remaining 9 years, right? You'll be having that comfort to use that 5 lakhs for some other purpose. Maybe you can do an investment in real estate or in share market and get some returns, So the longer the time for repayment, you're always happy, You want to take advantage of the option. Similarly, in the case of companies, you want the current assets to be financed more by this portion from the long-term sources because it gives the company buffers. We're only worried about the repayment of 75 lakhs. We're not worried about the repayment of 25 lakhs immediately. The 100 lakhs, normally 100 lakhs, if you had used 100 lakhs, what is this 100 lakhs? Say, for example, this is some finished goods, right? So you have manufactured some finished goods worth 100 lakhs. So since you borrowed some funds to produce this and you're going to sell this, you're going to realize some cash, obviously you have to pay back this 100 lakhs. But now we are saying you need not pay this 100 lakhs right now. You need to pay only 75 lakhs. 25 lakhs you can pay later, maybe after 1 year or 2 years. So this is a buffer. You like this scenario, right? Say, for example, this is instead of 75-25, this is 50-50 or this is 25-75. What I'm saying is out of this 100 lakhs, you pay 25 lakhs only right now, current liability. Whereas 75 lakhs, there is time, 2 years, 3 years. You want this scenario. So NWC or the long-term portion, okay, you want this to be high because you'll be having more time to repay. Any combination, you take any combination. There can be numerous combinations, 75-25, 25-75, 10-90, 80-20, whatever is the combination. You want a combination where you want to defer the payment for long term. You want the current assets to be financed more from the long-term sources. Or in other words, you want the NWC to be high. You want always the NWC to be high. When we're saying NWC is high, what we're saying is the portion of current assets that is financed from the long-term sources is high. You want that situation. You always want these current liabilities to be low because current liabilities is a dangerous situation. You have to make the payment right now or in the next 1 month or 2 months. There is a immediate obligation to repay this amount. You don't know how the situation will be. Whatever is the sales position, whether you make good sales or not. Maybe your market is not, maybe the industry is not doing well. Maybe your particular product is not doing well, but still you have to make this payment. There is an urgency. There is an obligation to make this payment immediately in the next 1 or 2 months, whereas this you don't have the immediate obligation, and that's why you prefer these sources. There is no immediate obligation to repay it. How much is the comfort? Here is the 25 lakhs. If it is 50 lakhs, it is even more comfort. If it is 25 lakhs, if it is 75 lakhs. So this gap here it is 25 lakhs. So this is a comfortable situation. If it is 50 lakhs, it is even more comfortable. So because only 50 lakhs you have to pay right now. If it is 75 lakhs, that means you have to pay only 25 lakhs right now. You want this. You like the situation even more. So you always want the NWs to be higher, right? Is this point clear? So this is something which we already discussed. NWC, the formula if you want, this current assets minus current liability. So in our example 100 lakhs, say for example the bank borrowing was 60 lakhs, 15 is the CC, so put together 75 is the short term sources and the long term sources 25 lakhs. So NWC if we apply the formula 100 minus 75 is 25. This 25 is nothing but the long term sources. So NWC is the portion of current assets that is financed by long-term funds. Please be very clear on this concept. NWC is the portion of the current assets that is financed from long-term funds. So if you were to, if somebody asks you in an interview what is NWC, please don't say it is current assets minus current liabilities. No, that is not the answer which they expect. Okay, that is the formula. Okay, but what is the interpretation? NWC is the portion of the current assets, because current assets are financed by long-term sources and short-term sources. Short-term sources like bank, CC, creditors, and other funds. This is the long-term sources, borrows, equity, some other long-term funds. So out of this current assets, how much portion is being financed from the long-term sources, that is NWC. So now we can say current assets is financed by NWC and current liabilities. Can I say this? Obviously, right? What I'm saying, current assets either has to be financed by short-term sources and long-term sources. This long-term source is nothing but NWC. So current assets are financed by one NWC and two short-term borrowings. Short-term, that's the current liabilities. This includes your bank borrowing, CC, your creditors, and other all other current liabilities, short-term liabilities. Okay, so remember this: current assets financed by NWC and current liabilities. Okay, this is a formula. If you want to put it in the formula, current assets is equal to the sum of NWC plus current liabilities. This is nothing but this, right? NWC bring this current liabilities to this side. Current assets minus current liabilities. Both are same. The concept is same. NWC is current assets minus current liabilities, or current assets is NWC plus current liabilities. That is the current liabilities. That is the current assets are financed by some portion by NWC and some portion by current liabilities. Okay. Now I told you we always want a situation where NWC is high. We always want this. Why? Because it provides a buffer. Okay. Because it is delaying the repayment. From, not just from the company's point of view, even from a banker's point of view, you want a company that has a high NWC because it has more comfort in repaying the short-term obligations. You want a company to be having good liquidity. Okay? You want a company to be having good liquidity. What is liquidity? It is the ability to meet the short-term obligations. Okay. So if you have a company that has a current assets, two companies which have current assets of 100, but for one company the current assets was financed by 80 lakhs long-term sources, whereas the other company only 20 lakhs was financed from long-term sources. You like this company more as a banker because this company will be having more liquidity. This company can meet the short-term liabilities easily, because if 80 lakhs was financed by long-term sources, the current liability is only 20 lakhs. So easily it can meet 20 lakhs, right? Easily can meet 20 lakhs compared to this company which has to meet 80 lakhs. Okay. So NWC is a measure of the liquidity, right? As a company, and I also as a banker, you want a company to be you prefer a company which has more NWC. Okay. Of course, assuming all of the things are the same. Now, if you recall our discussion which we had on the balance sheet, so under liabilities we have some long term and short term. So what are the long term? Let us classify this as long term liabilities. Okay, long term liabilities and short term liabilities. So what are the long term liabilities? You know what are the long term liabilities, right? So the borrower's equity, right? So bank term loans, unsecured loans, and all of that. This we already discussed, right? So I'm not going to repeat it. Short term also we discussed, right? What are this? Bank borrowings like CC, okay, creditors, advance from customers, okay. So all of this we already discussed, right? So similarly, we can have assets as current assets. We can have assets to be current assets and non-current assets. So current assets, so we discuss assets to be current assets, non-current assets, fixed assets, and intangible assets. Anyway, these three will club together and let us say long-term assets. Okay, in the sense that these are not assets that are going to realize us any cash in the immediate future. These assets will realize us cash. We are going to get some cash in the immediate future, like debtors and other debtors and inventory. Right? From these assets you can realize cash immediately, whereas this it will take some time. Okay. So again, let us classify these assets as long-term assets and current assets. Okay. So this is long-term liabilities, short-term liabilities. Okay. So now we are saying long-term assets, okay, and short-term assets. Right. Now see here. Who finances which portion is of great importance to you as a banker, as a credit officer. You are interested in the financing pattern, the financing mix of these four entities. Okay. Say for example, the long-term liabilities, this is 70, short-term liabilities is 30. Right. So you remember what is long-term liabilities, right? This is all the equity and term loan and all of the long-term liabilities. 70. If these long-term assets are also 70, and short term is 30. So can you say what is NWC? NWC we calculate as current assets minus current liabilities. So current assets is the short term assets 30. Current liabilities is short term liability 30. So in this case the NWC is 0. So if you look at the interpretation which we had, NWC is the portion of the current assets that is financed from the long term sources. So here there is no portion of current assets financed from the long term sources. So this entire current assets was financed entirely by the short term sources directly. So no long term sources were financing this current assets. Okay, so that's why NWC is 0. NWC 0 means the entire current assets were financed from the short term sources, short term liabilities. Okay, so no long term sources are financing this portion. Okay, so now I will modify this. Okay, earlier we had a line here, right? So that's why everything was same. This was 70, this was 70, this was 30, this was 30, right? So now I'm slightly modifying here. Have a look at this. Please see this. Now I will draw the line here. So earlier you had long-term liability 70, short-term 30, right? So now your long-term assets is not 70. Right? This entire is 70, okay? This entire is 70. What I'm saying is this is say 50. Short-term is another 50, okay? So you have a look at, you see what's happening here, okay? Your short-term assets were financed partly from your short-term liability 30 lakhs and partly from long-term liabilities 20 lakhs. Out of the 70, this is 20 and this is 50. Okay, your long-term liabilities of 70, what it has done, it has financed the long-term assets 50 and also some short-term assets. Is this clear? If you look at the formula of NWC, current assets minus current liabilities, here current assets was earlier 70, earlier current assets minus current liabilities was 0, right? 30 minus 30. Now current assets is 50, current liabilities is 30, 20. Again look at the interpretation. This 20 lakhs is nothing but this 20 lakhs. This long-term liability of 70 lakhs was split into 50 and 20. And this has gone into financing this long-term assets 50, long-term assets. This is short-term assets. So NWC, this 20 is the portion of the current assets that was financed from the long-term. So the long-term liabilities of 70 have financed long-term assets and something was left even after financing the long-term assets. Long-term liabilities were supposed to finance long-term assets, right? They financed that 50 was met, but still some 20 was left. Even after financing long-term assets, some portion was left. This is 20 and this 20 has gone into financing current assets. So this long-term liabilities have financed both long-term assets and short-term assets, right? And that is what NWC is. NWC here is 50 minus 30, 20. What is this 20? The portion of current assets that is financed from the long-term sources, right? For those of you who are curious, you might ask, what if there is a third scenario? Is there a third scenario where it could be like this? That is, this is 70-30, this is 80-20. Can there be a situation where NWC is negative? That is, here current assets 20 minus 30. Can there be a situation? What does this mean? What does a negative NWC mean? Okay, we will. This is possible, and this we are going to discuss shortly. Okay. For the moment, keep it aside because it's slightly complicated. We'll discuss it shortly. Okay. So that scenario is also possible. So the point I want you to remember at this stage is, after the long-term sources of fund, this includes the owner's equity, term loan, all long-term sources. After these long-term sources finance the fixed assets and non-current assets, okay, like buildings and machinery, they should be always available some surplus. In the earlier example, that 70 lakh long-term liability has financed 50 lakhs of fixed assets and other long-term assets. But still, even after that, some 20 surplus was left. This is nothing but NWC, okay. So even after the long-term sources finance the long-term assets, there should be available some surplus. There always should be some surplus which should be going to meet the current assets, the working capital requirement. So this portion is NWC. So what I'm saying is, a portion of working capital, as a banker, you should always prefer a situation where a portion of current working capital is coming from long-term sources. The higher the better, right? The higher this is the better. This we already discussed. Okay, we want a higher proportion of current assets to be financed by we want a higher proportion of the long-term sources to finance the current assets, right? But why bother about this financing mix? I mean, does it really matter? I mean, Does it matter if the current assets are financed 100% by short-term funds and 50-50 long-term, short-term? What is this? I mean, why are we so particular about this financing pattern? Why are we bother so much about this financing? So please recall the point we have made earlier. The comfort from long-term sources. What is the comfort we have from the long-term sources? It is that there is no immediate urgency to repay them. Short-term sources are entirely different. Okay, you need to make the payment immediately. Creditors are the number one pressure parties. Yeah, the pressure to pay them is enormous because if you don't pay them, they will stop supplying the material and your production comes to a stop. Right? The production, you see, raw material is the lifeline of your production process. If the raw materials don't arrive, your production will stop. And that's why companies are always scared about the raw material supplies. The first priority they give is to the payment to creditors, even more than the bankers. If you're a banker, you might have experienced this. They will delay the term loan repayment. The OGs will be running into 10 days, 20 days, months also, 1 month, 2 months. But the creditors payment, they will always make it promptly or with some delay. It's not as much a delay as a bank payment. Okay, because if they delay payment to creditors, they'll stop supplying and the production will come to a halt. Okay, so please understand that the short-term sources of finance. Please understand that the short-term sources of finance like creditors are there is a pressure to pay them. Okay, whereas from the long-term sources there is no such immediate urgency to pay them. Okay, so ideally you love a scenario where your entire current assets are financed by long-term sources. That is a top-class scenario to have. Because all these headaches are eliminated if you because all the short-term because there is no short-term urgencies at all. Though although you have to remember from the concept of financial management, this is not a great scenario. This is not a ideal scenario. That is an advanced concept. But anyway, intuitively, this is a good scenario because there is no headache of meeting immediate short-term payments. Okay. So let us take three examples. Okay, three scenarios. If you remember, this is something which you already discussed, but worth repeating. Okay. So in the first scenario, in all the scenarios, the current assets was 100 lakhs, right? But what is different is the long-term sources. So this 100 lakhs was financed some part from the long-term sources, some part from the short-term sources. Short-term sources are bank finance plus creditors. Okay, that's nothing but current liabilities. So in the first scenario, 100 lakhs was financed primarily from the short-term sources, 75 lakhs. So NWC is we calculate this NWC, right? NWC is current assets minus current liabilities. Current assets total 100. Current liabilities is this portion 75. So this is 25. In this case, 100 minus 100 is 0. In this case, 100 minus 125 is minus 25. So I told you that it is possible that NWC can be negative. So if you see in the third scenario, NWC is negative. So what is this scenario? Right? So what does it mean that NW is negative? Right? So current assets are 100. The current liabilities are 125. Right? So NWC is negative. So what is the interpretation of this negative NWC? Okay. Let's take a detailed look at this scenario. Okay. So here what we are saying is current assets minus current liabilities. So here it was 100, okay, and 125. So this is minus 25. So NWC is minus 25. So what is this minus 25? So if you had the money, right? If you had the money, the company has some money. Money means sources. So the money is obtained from various sources, okay, long-term sources and short-term sources put together. The company has some sources, okay. The money either should go, money is spent for some purposes, okay. What are these assets, okay? Company obtains funds through the liabilities and spends it on the asset side, okay. So these assets could either be long-term assets or short-term assets. Only two assets, okay. The incoming money, that's the liabilities, so it could be only current liabilities or long-term liabilities. Only two possibilities. And even on the spending side, only two possibilities. Either it should be the current assets, the short-term assets, that is the short-term assets or the long-term assets. This is very simple. There are only four possibilities. On the liability side, either it should be a current liability or a long-term liability. On the asset side, either it should be a current assets or a long-term asset. Simple. Okay. So let us assume that let us concentrate on this portion. If you had the money, if the company got some money from various sources, either it should be spent on, there are only two ways, either it is going to be spent on the current assets or the long-term assets, okay. So have a look at this scenario. In this scenario, the company has got 125 lakhs of current liabilities, right? Company has got funds from 125 lakhs current liabilities, okay. let us for a moment assume that this long-term liability is 0, even though this will not be the case in reality, but for the moment let us assume it's 0. Okay, so the company has got 125 lakhs of current liabilities. So what we said, either you should go this entire amount 125 plus 0, that is 125, this total money 125 should either go to long-term sources or short-term sources. Okay, so 100 lakhs it has gone to current assets. Okay, so current assets 100 lakhs, out of this 125, 100 lakhs has gone to short-term assets. That's the current assets. So tell me, where will the balance 25 go? Obviously to the long-term assets. There is no other way. Either it's a short-term asset or a long-term asset. So out of this 125, and you are saying, so what we are saying, what we mean by NWC is negative is, right? When we are saying NWC is negative, in this example, what we are saying is the 125 lakhs has met entirely the short-term assets. Fine. Entirely the short-term, the current assets was met. Entirely 100 lakhs was met. But even after meeting that 100 lakhs, even after entirely meeting the working capital, the requirement of current assets, some surplus was left. The current liabilities was 125 lakhs, but actually you require only 100 lakhs. The current assets you require only 100 lakhs, whereas you had amount of 125 lakhs coming from the short-term sources, 125 lakhs. So even after meeting all the current assets requirements, still you are left with additional 25 lakhs. That 25 lakhs, where it will go? Obviously to the long-term assets, right? Obviously to the long-term assets. So remember, whenever you have a negative NWC situation, it means this amount, whatever it is, this 25 lakhs has gone into the long-term sources, long-term uses. It has not gone into the short-term uses. Short-term uses is already met. Even after meeting the short-term assets, that's the current assets, some amount was still left, and that has gone into the long-term assets. Now please remember, this again I will clarify once again, but please remember, your short-term sources, should never go to long-term uses. Please be very clear on this concept. Absolutely, please keep it in your mind. Right? Please be very clear. Long-term sources of funds and short-term sources of funds. There are two sources. Okay. So what are the long-term sources of funds? Borrows equity, bank term loan, and other sources. Short-term means creditors, bank CC, and other short-term sources. Your long-term sources can go anywhere. No restriction. You can finance the long-term assets or the short-term assets. No restriction. Long-term assets like land, building, like fixed assets, right? All this you can do. Or short-term assets like current assets, your inventory and debtors. No restriction. Absolutely no restriction. Allowed. Totally allowed. But your short-term sources should only go to short-term assets. This is not allowed. Long-term assets. Your short-term sources should never go to long-term assets. And if it does, if such a scenario arises, we call this diversion of funds. Yeah. Your short-term sources should never go to long-term uses. It is not permitted. Short-term sources are meant only to finance the short-term assets. You can understand this. You can understand why there is this restriction. Why there is this restriction. Say for example, let us take the example of a company. Let us take the example of a bank. We are starting a new bank. Okay, we are starting a new bank. So for simplicity, let us assume we have only a single depositor, and we have only one loan. So we are a new bank. Okay, we are a new bank. We have only one customer from the depositor side, and only one customer from the loan side. Okay, so so this borrower made a deposit of 100. Say for example for 1 year. So some interest you're paying, so maybe some 10% or whatever interest you're paying. Okay, so we had only one depositor who has made a deposit of 100 crores in our bank, and we have to give back this deposit out of 1 year. Okay, now what we do with this 100 crores? Obviously you have to do some business, right? You're not going to get this, you're not going to give this. How you're going to pay this 10%? Only if you do some business. Okay, so you're giving this 100 crores as a loan to some other party. We have only one customer, so you're giving a loan of 100 crores to the customer. Obviously you charge a higher rate of interest, 15%, and the balance 5% is your profit. Okay, from this 5% you deduct some operational expenses. Anyway, some profit you'll be getting. Now this loan you are given for a period of 3 years, right? You're saying you repay after, you do business and repay after 3 years. There's a huge problem here. After 1 year, your depositor will come back to you and ask, give me my 100 crores. Whereas that 100 crores is blocked for 3 years. This 100 crores, you can't go to this party and say, this borrower is asking me 100 crores, give me back my 100 crores. You can't say that because 100 crores is not in the form of cash. This borrower has constructed some buildings, he has purchased some machinery, something is gone into, it's got converted into some other form. No cash, right? The problem here is this is a short-term source, short-term liability. This has gone into long-term asset. This is a mismatch. This is a 1 year, where this is 3 years. Had this been 3 years and this is 1 year, absolutely no problem. After 1 year, you would have got back your 100 crores. This borrower is going to come back only after 3 years. You could have happily repaid him. So this in that case is a long-term liability, and this is a short-term asset. So that is okay. That is acceptable. But this is not acceptable. This 1 year and this is 3 years is totally not acceptable. As a banker, you don't want this situation. Say for example, as a banker, you have given a borrower a short-term liability, a short-term loan, say for example 100 lakhs, and you say repay me after 1 year. So short-term source is 100 lakhs. Okay. Now you said you do some business, purchase some raw material, get converted into finished goods, sell it, and you repay me after 1 year. Okay. Now what this borrower did, he took this 100 lakhs and put it in. You wanted him to invest this 100 lakhs in short-term assets. But what that borrower did, he put this 100 lakhs in long-term assets. Maybe he purchased some land, right? Something he did, right? Constructed some building or something, right? The problem with this is, after 1 year, when the time comes to repay you, he can't repay you. Why? Because it is not in the form of, this is not something going to be realized quickly. This has gone into creation of fixed assets. Though theoretically you can sell a building and realize cash, but that is not the purpose why he has constructed this building. This is gone. This is not going to be realized so quickly, right? You never want a situation like this. You don't want your short-term funds to be blocked in long-term assets, because the repayment will become difficult. See, your long-term assets can be financed by long-term sources. That's okay, because there is no immediate obligation to repay these long-term sources. There is time. That's okay, but this is not permitted. Your long-term assets, if you finance from short-term sources, at the time of repayment of the short-term sources, there will be a problem, because the funds are not available readily, right? This is not liquid funds. Okay, this is gone into creation of fixed assets. So as a banker, you never encourage a situation where your long-term assets are financed by short-term sources. You always want your long-term assets to be financed by long-term sources only. So please keep this table in your mind. This is a table you have to always remember as a banker. Long-term sources can go anywhere, either long-term, short-term, no restriction. Short-term sources should only go towards short-term assets. So when we say, in our earlier example, when we said NWC was negative, current assets minus current liabilities, right? Current assets was 100, current liabilities was 25 minus 25. This minus 25, whenever NW is negative, this is the situation. What we are saying is, current liabilities have financed the current assets. Current assets was 100, okay? But you had 125 lakhs of funds of current liabilities. So you met the entire current assets, but still you are left with some more amount of 25 lakhs that has gone into long-term assets. And that's where the diversion of funds has come. So you never want a situation, this sort of situation. You never want a negative NWC situation. Negative NWC means indirectly we are saying that the short-term sources were diverted to long-term assets. So you never want NWC to be negative. So why will this situation arise, right? Why will this NWC be negative? Why will this situation arise? So NWC, we said it is current assets minus current liabilities. Okay. So in our earlier example, this was 100 minus 125. Okay, minus 25. So why will this situation arise? Why will the current liabilities be high? Right. So what are current liabilities? So we simplified it as saying it is either from the bank side, CC, or from the creditors. There are other items also, but for simplicity, let us assume these are the two items. So when the requirement is only 100 lakhs, please understand this, when the requirement from the current assets is only 100 lakhs, why would anybody give 125 lakhs? So whose fault is it that when the requirement of the current assets is only 100 lakhs, you had made available 125 lakhs to the company? Since 125 lakhs was available, the company happily diverted 25 lakhs to the long-term sources. So what will the company do? I mean, it has got surplus funds. 100 lakhs it was sufficient to meet the current assets, whereas it has got 125 lakhs at its disposal. So the surplus 25 lakhs, it has used it for long-term sources. So long-term uses. So can you blame the company? So who is to blame here? Who made this 125 lakhs available to the company when only 100 lakhs was required? So whose fault was it? So these two are at blame. These two are to be blamed. But the problem is, these two don't coordinate. Will you as a banker call up the creditors and say how much you're financing, the balance I will finance? No, you won't do that. So there is no coordination. So what you do as a banker? You find out what is the creditors amount. So I'm speaking of the assessment will be taken up later in this chapter. we'll go through in a detailed fashion, but let us understand the concept. Okay, when you try to ascertain how much CC you have to give, what you're going to do is, what you need to do is find out the total current assets requirement. In this, say 100 lakhs. You find out what is the creditors, say 25 lakhs. So balance 75 lakhs. So we will say this, we can say this, can we call it as a, say, working capital gap. Okay, and then you will say out of this 75 we will finance only this. Of course, some portion of margin you have to get. Okay, so as a borrower you get some margin of 25, so only balance 50 I will finance as CC. So as a banker, this is what you should be doing. You should be always keeping you should always keep an eye on what are the other short-term liabilities besides you, that is the creditors, and you finance. So if when this amount is high, what we are basically saying is either the assessment is not proper from the bank side, and that's why it has made available 125 when the actual requirement is only 100. Either the bank has overfinanced, or there is another possibility. The creditors have given more. Why the creditors have given more? There could be two reasons. Why this has happened. Your current liabilities are high either because the bank has given more or the creditors have given more. When the bank has given more, it is basically saying the bank has done a poor assessment. Your appraisal was not proper. When the requirement was 100, you sanctioned more. This is overfinance. This is a problem of the bank. Okay. There could also be a reason where the creditors are high. This could be possible. Say for example, you are a very reputed company like Reliance, a huge company. Okay, Reliance Industries is a huge company. A very small company, company X, small company. Okay, if you get an order from Reliance, oh, you're very happy. You're a supplier. Say Reliance wants to buy some material from you. Right, you're very happy to supply because this is a recurring order. You're supplying to a huge company, and if they're satisfied with your performance, they'll definitely come back to you for more. Okay, so you are at the mercy of you are at their mercy. Okay, the Reliance Industries is dictating terms to you. Normally suppliers will dictate, but this is a scenario where the Reliance Industries is dictating because it's a big company. Okay, but now there are other companies. Why is that? Everybody wants to do business with Reliance, and products, let us say the products by and large are same. There's no great difference in quality. So how are they going to differentiate? X will say, Z will say, okay sir, okay, you pay me after 1 month. I will give you a rate of 1 month. Y will say, you pay me after 3 months. What he will say, you pay me after 6 months. When the product is by and large same and there is no differentiation on the quality of the product and price, they are going to differentiate on the credit period. So now Reliance Industries obviously loves this supplier. He's giving you more time. It's not that Reliance Industries can't pay you immediately, right? But any company will like to prolong that the period, because they'll be having more flexibility to use the funds elsewhere. It's not a big amount, but the point is, as a company, you want to delay the payment because there's no cost associated with it. So even after 6 months, you have to pay the same amount. Even if you pay today, it's the same amount. So you want to pay after 6 months, right? So when you're a reputed company, you'll be having a very high amount of creditors. So in the books of the supplier, it's a debtor, okay? Reliance is a debtor, okay? But from in the books of Reliance, it will be a creditor. This X will be a creditor, and this amount will be high, right? So if you're a very reputed company, your creditors will be high, right? This is something which the banker cannot control. If there is a very reputed company and there are many suppliers who are willing to extend a very high credit period, there is nothing you can do. But even then, you have a role to play. How? You have to finance only the balance portion, right? Say for example, the total current asset requirement is 100. Normally for other companies, say CC, you're financing some 60. Okay, creditors are financing 15. A borrower is financing his margin of 25. This is how the normal scenario works. But this company has a very high creditor, has a very high reputation, and everybody is wants to supply this material, and everybody wants to offer higher credit terms. So this 15 instead of 15 is now very high, say 50. As a banker, what you should do is, okay, 100 lakhs is the total requirement, but 50 is already being met by creditor. So the gap is only 50. We have to finance only 50. So out of this 50, okay, you bring in your margin. Okay, 25, some 10, and we'll finance only 40. Now the 60 will not be 60. So now your CC will not be 60. It will be only 40. That we are saying the bank has overfinanced or there's more creditors, right? This is a faulty appraisal. You should never overfinance, right? And this scenario, when you have high creditors, you have to cut down on your bank finance and ensure that the company is not overfinanced. Okay, this will be clear as we do a couple of exercises which we'll be doing in this chapter, right? But the concept is basically this, okay? NWC, negative NWC means, right? When you're saying NWC is negative, this means your short-term sources are gone, some portion of short-term sources have gone into long-term uses, and this is not a favorable scenario, right? So there is a term for this, right? There is a term for this called working capital gap, right? So if the total current assets requirement is 100, of this we are saying the three major parties are the three major parties who finance this are the margin, the borrower's margin, bank in the form of CC, and creditors. We are saying these are the three main parties who finance the current assets, okay? So as a banker, what you should do is you find out to ensure that the unit is not overfinanced, because there is no coordination between you and the creditors. You don't call up the creditor and say, oh, how much you are given, the balance I will give you. You can't do that, okay? You're not directly directly communicating with the creditor. So you produce the financials, balance sheet of the company, and see what are the creditors, okay? So you get an idea that out of 100 lakhs, the creditors are financing some 20%, okay? You get a rough idea. So what you will do is you will say, I will finance only the balance. Say this is 20, okay? I will finance only the balance. This is known as working capital gap. Working capital gap is your total current assets requirement minus the creditors portion. You take out the creditors portion, and as a banker you will say we'll finance only 80. Even this 80 we won't finance, because this 80 has to be financed both by the borrower and the bank. There's some margin. How much is margin? Okay, that we can take care of later. 10%, 25% of this you finance. That is different matter. But this portion, this current assets minus creditors, is known as working capital gap. As a banker, first of all, you arrive at the working capital gap, and from this working capital gap, you carve out what is your portion, what is the borrower's portion. Maybe 25% the borrower should bring, 75% bank will finance. So this will ensure his margin is there, and this will ensure your CC is there. Okay. So this is how you'll do. So please understand this term working capital. Working capital gap. Working capital gap is current assets minus creditors, right? So let us take an example. So in this example, in all cases the current assets was 100. What is varying is the creditors portion. So if 4 proposals have come to you, so this is how you calculate the working capital. This is the working capital gap. Okay. The current assets minus creditors is the working capital gap. 75. In the first case 75, 50, 25, 0. Okay. So this current assets less creditors known as the working capital gap. This gap is to be financed by whom? It has to be financed both by not just by bank, both by the bank and the borrower, the margin, the promoter's margin. Okay. The two parties has to finance this, the borrower and the bank. How much should each contribute is which we'll see shortly, right? But the point is working capital gap is the first point, which is the first thing which you calculate, right? Because there are three parties, okay? The bank, the creditors, and the borrower's margin. Only these three will be financing the current assets, right? So if you want to know how much you have to finance as a banker, first of all you take out the creditors portion, because you don't communicate directly with the creditors. You first of all find out how much this is from the financials, and say this you are at 25. So 100 minus 25, 75. So only 75. So this 75 has to be financed by both by bank and the margin. So put together we'll finance 75. How much should each contribute? We'll see now. So yeah, 75 lakhs we arrived. Okay. In the earlier example, working capital gap 100 lakhs current assets minus creditors is 25. 75 lakhs you arrived. So this 75 has to be met both from the bank and the borrower margin. So how much should each contribute? Whether the bank should take up the entire 75 lakhs and borrower not contribute anything, or bank will not finance anything, or 75, or some other combination, 50, 25, 25, 50. What is the combination? The borrower obviously will want this scenario. He'll say, I will not bring my margin, you finance the entire 75 lakhs. But we already discussed the concept of margin. That is not acceptable. There should always be borrower's stake in the business. So option 1 is ruled out anyway. Option 4 is also ruled out. I mean, why would a borrower put in his entire 75 lakhs? Why would he approach you? Why would he approach the bank? Okay. So he wants some finance. And if you go by this scenario, bank will not do any business. Okay. So you also as a banker want to do business, you want to give some finance. So how much? Well, the question of how much margin is a huge story. It's a very long story. There are a lot of committees involved. Okay. Tandem committees, various other committees. Okay. We'll push this all to a subsequent chapter, right? We'll not discuss this because the flow of this chapter will be disturbed if we start discussing about the committees. We will discuss them at an appropriate stage. Right now, let us discuss a method that's commonly used. Most Indian banks use this method. So let us focus on that method. So in Indian banks, 25% is a common margin that is stipulated. for large borrowers. Okay, for small borrowers this can vary 13%, 20%, that varies, but for large borrowers it's 25%. So let us take 25%. So we said that current assets was 100 in the example. Okay, and out of that uh, 25 lakhs was already met by the creditors. So this balance 75 lakhs known as working capital gap is now to be met from the both from the borrower and the borrower margin and the bank. So how much he should contribute? So 25% is the margin. So 25% of not of this working capital gap. Okay, 25% of the current assets. We always denote the margin as a percentage of the total current assets. The total current assets is 100. 25% is the margin. 25% of current assets is 25. So out of the balance 75 lakhs, the borrower will be bringing his 25 lakhs margin, and the remaining only will sanction 50 lakhs as CC. So the total 100 lakhs current assets are now financed by 50 lakhs CC, borrower margin 25, this is the margin, and 25 lakhs from the creditors. Right, this is the financing pattern. What if the company could get a lot of creditors, as in the real example, like a huge company like Reliance? What if this creditors is very high? Creditors instead of 25 is 50. So will we end up financing 125 against 100? No. In that case, you will reduce your share to 25, so that in the end the total will be 100. You will be the final authority when the company comes to avail working capital finance from you. You will decide. You'll first of all see what is the creditors level. You deduct that from the total current assets, the balance you arrive, and from that you stipulate the borrower's margin and balance, and finally you arrive at the working capital requirement to ensure that the company is not overfinanced. Okay, so let us clarify it once again. We will do a more systematic way of working capital assessment later. This is just a rough guideline. So what you do basically, arrive at the total current assets. In this example, let us say this is 100 lakhs. Okay, from this is just a flow chart. Okay, from this you deduct creditors. So what we'll get is known as the working capital gap. So in this example, let us say we have 25 creditors. So 75 is the working capital gap. Okay, from this working capital gap, two people have to meet this working capital gap. One, the bank should meet, and there shall also be a borrower margin. Right? So two parties have to meet. So how much should each meet? So we said margin will be 25% of current assets. Current assets is 100. So this is 25. Right? Out of 100, 25 lakhs is the current. This is the margin. Right? So 25 lakhs is the margin. So the balance, whatever is the balance here, 50. That will be the working capital facility we are going to sanction the borrower. Okay. So this is basically the methodology we'll be following in any bank for working capital assessment. Arrive what is the current asset requirement. From that arrive the working capital gap by reducing creditors, and that working capital gap split it between the bank and the borrower's margin. Whatever is the borrower's margin, deduct it, and the rest will be taken up by the bank. Okay, this is the basic methodology that you're going to use, the banks use in calculating and doing the working capital assessment. We'll take up example shortly that will clarify the concept more clearly, but this is the basic outline, right? So one more example. So there are 5 scenarios here. So current assets is 100, creditors is 30. So first step is deduct creditors and arrive at the working capital gap. So 100 minus 30 is 70. Now what is the borrower's margin? 25% of current assets. 25% of current assets is 25. The 25% might vary. For large borrowers is 25. Some banks will have 13%, for short borrowers 20%. So it will vary. So in this example is 25%. So 25% of current assets. So 25. So balance 70 minus 25, 45 will be the bank finance. Another example. Current assets is 100. Creditors is only 10. So the working capital gap is 90. This 90 has to be shared between the bank and the borrower. So this is a small borrower. As per the bank's policy, the borrower's margin should be 13% of current assets. So 13% of 100, 13. So balance 90 minus 13, 77 will be financed by the bank. So the bank will always finance that portion after meeting the creditors and after deducting the creditors and the borrower margin. Okay, this is the calculation. Okay, so this calculation is straightforward. There is no problem in the calculation. That is quite straightforward. But however, this is straightforward. This you will get from the balance sheet. You can always calculate it. That is available straight away. This is a bank policy percentage. That is this calculation A minus B. This is also available. Once you have this figure, these two figures you'll have. Minimum NWC amount is this is right. 25% of this, right. So this is available. The problem is with current assets. How do you arrive at the current assets? What is the correct amount of current assets investment required for this particular company? How do you arrive at? or in banking terminology, what is the level of current assets that is suitable for this activity of this for this particular company. In this example, we said 100 lakhs, okay, but who have this 100 lakhs? Company might say, 100 lakhs is not sufficient. We require 150. That's very critical, because if you change that one column, everything else change. Your bank finance will also change. Say, for example, company is saying, no, not 100 lakhs. We require 150 lakhs. For our company, we require current assets of 150 lakhs. Same figures, let us take. Credit assets is still 30. Working capital gap is 150 minus 30, right? So this is 120. Current assets 25% of current assets, 25 of 150. So this is 37.5, right? By 4. So, right? So what is the bank finance? C minus D. 120 minus 40. 120 minus 40 is 80. So 82.5, right? So see, the difference between this and this case is only the change in the current assets. I have changed only current assets. Rest everything I have remained the same, right? And suddenly your bank finance is changing. So as a banker, you might say company requires only 100 lakhs. The company will say we require 150 lakhs. So you say bank finance 75 lakhs. I will sanction only 45 lakhs. Company will be asking please sanction 80 to 82.5. So who is correct? How do you arrive at this current assets? What is the correct level of current assets for this company? Right? That is the most critical point in this entire calculation. That is the critical point. Everything else is straightforward. Okay. So the correct level of current assets varies from industry to industry, right? And even for a particular industry, it varies from a company to company, right? It varies from industry to industry, right? For example, a retail trader will be requiring less working capital because he doesn't require raw material. Okay. Similarly, departmental stores like Spencer's, right? They're selling mostly on cash basis, very little receivables. Okay, so they'll be requiring a lower receivables. Whereas a manufacturing company might have a higher investment in current assets. So it will vary from industry to industry. Even within industry, not all companies require same level of current assets. Right? A small company with say 1 ton capacity is totally different from a large company from 100 tons capacity. Right? 100 lakhs current assets might be a huge amount for a small company 1 ton capacity, whereas for a large company 100 lakhs, that is 1 crore is not sufficient. Maybe it requires 10 crores. We don't know. So what is the required level of current assets? What is the desired level of current assets? Is it 10 lakhs or 50 lakhs or 200 lakhs or 10 crores? We cannot speak in absolute terms. Are you getting the point? We cannot speak in absolute terms. Why? There is a cement manufacturing unit. A cement manufacturing unit is. So as a bank, you're framing your policy. Cement manufacturing unit, steel manufacturing unit, okay, fertilizer manufacturing. You're fixing some guidelines. You're saying for a cement manufacturing unit, 25 lakhs current assets is sufficient. For steel manufacturing unit, 40 lakhs is sufficient. Fertilizer, 60 lakhs is sufficient. You're stipulating some limits, but this is wrong. You can't do like this. Why? Because you're not taking into consideration the capacities of this firm. A cement manufacturing plant or a small plant of say 1 ton might manage with 25 lakhs. That is sufficient. But for a big firm like 10 tons, 25 lakhs is not sufficient. So you cannot speak in absolute terms, right? Because it varies from company to company based on the capacity. So let us not speak in terms of absolute value. Let us speak in terms of holding levels, right? In working capital assessment, a very important concept is the holding levels. Please recall the earlier slide where we said the most important point is arriving at the current assets, right? If you go back, the most important point is to arrive at this current assets, because if you change this amount, we took this example, right? Just by changing this amount from 100 to 150, your bank finance has changed from 45 to 80, 82.5, right? So this has changed, right? So the most important, as a credit officer, the most important point in working capital assessment is to arrive what is the correct amount of current assets this particular company requires. Okay, and you cannot have a blanket rule saying all cement manufacturing companies require 25 lakhs working capital. That is sufficient. You can't say that, right? All steel manufacturing companies require 50 lakhs working capital. You can't say that, because again it varies from company to company, capacity by capacity. So we speak to arrive at the correct level of current assets. We speak in terms of what is known as holding levels. Okay, that will be a discussion of our next segment, right? See you then.